Ever wondered how to understand financial statements? Well, buckle up, because we're about to embark on a journey into the world of finance. Financial statements, often considered the report cards of businesses, are crucial for making informed decisions. These documents provide a snapshot of a company's financial health, showing us where the money's coming from, where it's going, and where it's currently sitting. There are three main types of financial statements. First, we have the balance sheet, a snapshot of a company's assets, liabilities, and equity at a given point in time. Then there's the income statement, which shows us how much a company has earned or lost over a specific period. Finally, we have the cash flow statement, tracking the flow of cash in and out of the business. Now think of these statements as different chapters in a company's financial story, each revealing a unique aspect. Now that we know what financial statements are, let's dive deeper into each one. First off, the balance sheet. It's like a snapshot of a company's financial position at a specific point in time. Now let's break it down into its components. First, we have assets. These are what the company owns. It could be cash in the bank, properties, or even patents. Imagine a tech startup. It may not have a lot of tangible assets, but its intellectual property, the software it develops, that's an asset. Next up, liabilities. These are what the company owes. It could be loans, unpaid bills, or salaries due to employees. Picture a restaurant. It may owe money to food suppliers or have a bank loan to pay off. Finally, shareholders' equity. This is the ownership interest of shareholders in the company. It's what's left after subtracting liabilities from assets. So the balance sheet tells us what a company owns and owes. But what about its earnings and expenses? That's where the income statement comes in. Next up, the income statement. It shows a company's earnings and expenses over a period of time. Think of it like a report card for a business, but instead of grades, we're looking at money. First, we have revenues. This is the money a company earns from selling goods or services. Imagine a lemonade stand that sells 100 glasses of lemonade at $1 each. That's $100 in revenues. Then we have costs, which are the expenses of running the business. For our lemonade stand, this could be the lemons, sugar, and cups. Let's say these costs total $30. Subtract the costs from the revenues and voila, we have profit. In our example, the lemonade stand made a profit of $70. With the income statement, we see a company's profitability. But how about its cash flow? For that, we need the cash flow statement. Finally, the cash flow statement. It reveals how much cash a company generates and spends during a given period. This statement is divided into three distinct sections, each telling its own tale of cash flow. First, we have the cash flow from operations. This section discloses the cash generated from a company's day-to-day activities like selling products, paying salaries, or buying inventory. Think of a cafe selling cups of coffee. The revenue from these sales would be part of the operational cash flow. Next, we have the cash flow from investing activities. This reflects the cash used for investments in assets, such as purchasing a new espresso machine for our hypothetical cafe. Lastly, there's the cash flow from financing activities. This involves the cash transactions related to a company's equity and debt. For instance, if our cafe owner took out a loan to expand, that would be reflected here. Now, we have a basic understanding of financial statements, but how can we analyze them? This is where ratio analysis comes in. Ratio analysis is a powerful tool for evaluating a company's performance and financial health. It's like a financial magnifying glass that allows us to zoom in on a company's fiscal details. Let's break it down into four main types. First, we have liquidity ratios. These measure a company's ability to cover its short-term obligations. Think of it as checking if a company can pay its bills. For example, the current ratio compares a company's current assets to its current liabilities. Next, we have profitability ratios. These tell us how effectively a company is using its resources to generate profit. A classic example is the net profit margin, which compares net income to revenue, giving us a percentage that shows how much of each dollar earned is actual profit. Then, we move to efficiency ratios. These help us understand how well a company is using its assets and liabilities internally. For instance, the inventory turnover ratio tells us how many times a company has sold and replaced its inventory during a certain period. Last but not least, we have solvency ratios. These reveal a company's ability to meet its long-term obligations. A common example is the debt-to-equity ratio, which compares a company's total debt to its total equity to gauge financial stability. Remember, these ratios are most useful when compared over time or against other companies. Ratio analysis can give us insight into a company's performance. But for comparison purposes, we need common size analysis. Common size analysis allows us to compare different companies, regardless of their size. It's like a magic magnifying glass that scales everything to the same level, enabling us to make meaningful comparisons. So, how does it work? Let's dive in. Common size analysis involves converting each line of a financial statement into a percentage of a base figure. For example, in an income statement, each item is expressed as a percentage of total sales. For a balance sheet, each item is expressed as a percentage of total assets. This standardization makes it easier to compare financial statements of companies of different sizes. It can also help identify trends over time within a single company. Imagine two companies, a giant multinational corporation and a small local business. On paper, their financials may look vastly different, but with common size analysis, we can directly compare their profit margins, cost structures, and other key indicators. Let's say, for instance, the multinational's cost of goods sold is 40% of its total sales, while the small business's is 50%. Even though the multinational's total sales are much higher, we can see that the small business has a less efficient cost structure. Common size analysis can also highlight changes over time. If a company's research and development expenses increase from 5% to 10% of total sales over a few years, that could indicate a strategic shift towards innovation. With common size analysis, we can compare apples to apples, making it a powerful tool for financial analysis. So we've covered a lot today, haven't we? We've delved into the world of financial statements, exploring the balance sheet, income statement, and cash flow statement. We've also tackled ratio analysis, unveiling the secrets behind the numbers. And let's not forget about common size analysis, a tool that allows us to compare companies of different sizes. Remember, understanding financial statements and analysis is a critical skill in finance. Keep practicing, and it will become second nature in no time.